In this video, I'm going to demonstrate variable cost variances using exercise 1636 as an example. So this problem is just really a continuation of 1634 and 1635. And in particular, if you recall the profits variance analysis from 1635, there were several key variable manufacturing variances, and they were direct material, direct labor, and manufacturing overhead. Again, not the activity variances, but our manufacturing variances. With our variable cost variances, we're going to drill down and break those into two different categories to gain a better understanding of what caused them. For example, one of the categories is going to be what we call a price or rate or spending variance. So what we're trying to understand there is what part of that variable manufacturing cost difference had to do with paying more or less per unit for that material than we anticipated. So let me use direct labor as an example. Did we come to a contract renewal and our employees negotiated a much higher pay raise than we anticipated? So our spending was greater for direct labor, didn't have anything to do with the quantity, because they negotiated a higher pay rate. The other separate category is what we call a quantity or efficiency variance. Now, I want to stress this has to do with the input quantity, not the overall sales activity level, but the input quantity. For example, direct labor. Did I do a terrible job as a boss? I didn't train my employees well, and naturally, if I don't train them well, they're probably going to take a lot longer to finish those same items. So again, my spending's more for direct labor, not because I'm paying them more per hour, but because they're having to work more hours to produce the same output. That would cause what we call an unfavorable quantity or efficiency variance. I'm going to go ahead and start out with direct material as my example, and I tend to navigate to the formula approach for my variable cost variances. The book addresses a more visual columnar format. It doesn't matter, whatever approach is more natural. I find with accounting and finance student, the formula approach typically sticks better, but hey, if that columnar format and visual format is better for you, we're both going to get to the same end answers. For our formula for any price variance, it seems natural, I'm going to address what's in the parentheses first, to look at the difference between the actual price and the standard price. What did I pay per unit versus what do I think I should have paid per unit? And I do want to stress this is on a per unit basis. Then I'm going to multiply that, not just look at it on a per unit basis. I'm going to expand that or extrapolate that by multiplying it times the actual quantity purchased. For my quantity or efficiency variance, again, seems natural, looking at what's in the parentheses, to look at the difference between the actual quantity versus the standard quantity. Here's where there's a difference. When we did the pricing, it was on a per unit basis. When we do the quantity, it's total quantity. So what's the total quantity of material used versus the standard of what I thought I was going to use? And we want to put this on a dollar basis, not just leave it at quantity. So we're going to multiply it times the standard price per unit. So you may look at this and go, this is going to be really confusing because here I'm using an actual, here I'm using a standard. Let me explain the nuance of why I use standard price here. Whoever I'm going to hold responsible for using more or less material, I also don't want to either, basically ding them, for perhaps a price, a higher actual price that was paid compared to what they anticipated. So I want to use the standard price. Now, it's fairly easy to remember the formulas. The hard part is picking out the information to fill out those formulas. So let's go through that with direct materials. Our actual quantity is given to us. That's the actual quantity of material that was purchased, and that's 176,000 pounds. And I do want to stress for this problem, for my other two problems, they had us rounding things to the nearest 1,000. We don't do that. The next variable is actual price, and keep in mind that's actual price I paid per unit. Unfortunately, they're not as nice to give us that information directly, but they give us enough information that we can figure that out. In particular, we have our income statement that gives us the actual information. And represented within that, we have the 748. Remember, that's really $748,000 of spending that we actually did for direct materials. So if I take that 748,000 divide it by the pounds of material that I purchased of 176,000. My actual spending per pound was 425. Standard price per unit, thankfully that's given to us, and it's $4 per unit. Here's another trick. You see two different prices listed for direct material. I want the price per pound or per unit for $4. I'm not looking at the total amount of material that goes in a finished liter. I'm looking at what I'm paying to acquire that direct material per unit. Now, several of these items are also used in my quantity variance, my standard price and actual quantity, but I also need to figure out my standard quantity. That is for the 94,000 liters of sales that I had, how much material do I think I should have used for that? So I'm going to take my actual output, 94,000 liters, and multiply it times my standard of how much I think I should have used, which is 2 pounds per liter. And that tells me I thought I should have used 188,000 pounds. That's, to me, the hardest part. It's easy putting them into the formula, but let's work through this. So my actual quantity of 176,000 pounds times the difference between my actual price of $4.25 minus my standard price of $4. So a 25-cent difference times 176,000 pounds is 44,000. Here's where another tricky part comes, though, and often students identify this incorrectly. Is this favorable, unfavorable? Some like to remember the positive, negative. Because we're talking about cost and this is a positive number, this is actually going to be unfavorable. Again, positive, unfavorable, negative, favorable. I know that sounds contradictory, but we're talking about cost. But I also recommend just step back and really think about this. I paid 25 cents more per pound. That's not a good thing because that's additional cost I didn't anticipate, so it's unfavorable. Now I want to tackle direct materials quantity variance. And so we're going to take our standard price of $4 and multiply it times the difference between what we actually used, 176,000 pounds, minus what we anticipated that we should have used, 188,000 pounds. And so again, the dollar overall extended difference is 48,000. But again, interpretation. You look at this and go, well, it's a negative number, so obviously if I follow your rule of thumb, it's going to be favorable. But also step back and think about this. I used less material than I thought I should have used. Hopefully we didn't affect quality issues here. Using less material is a good thing, again, unless I affect quality issues, so this is going to be favorable. A couple additional things I want to address here is who's typically responsible, like when we're talking about direct materials. For our price variance, that would usually be the purchasing manager. So that, it'll be a situation, how good did they do with negotiating the price? Quality can also affect. So, in this situation, maybe they purchased a higher quality than we anticipated, so it ended up costing us more. It's possible it doesn't have anything to do with the purchasing manager. Maybe the production or plant manager is telling them so late that they need to order that they're having to pay rush charges or higher shipping charges. That's part of the cost of the materials, and it's causing us to have an unfavorable variance. So I would need to investigate to gain a better understanding. Who's typically responsible for the quantity variance? That's typically going to be the plant manager. So, items here are how well are you training your employees? How skilled are your employees? How well are you maintaining things like equipment? If I'm not doing a good job of overseeing the maintenance of equipment and things are breaking down, I'm going to end up using more materials. If I'm not doing a good job of monitoring my employees, again, they may be breaking things. I may need to use more materials. Quality of materials might also have an impact here. For example, there may be a correlation. Maybe my purchasing manager bought better quality materials and it costs me more from a price variance perspective, but because they were so high quality, I didn't have to use as much, so I ended up saving the amount of material that I could use, and I had a favorable direct materials quantity variance. Overall, when I look, and these are different signs, one's unfavorable, one's favorable, I end up with a total, because they cross against each other, 44,000 unfavorable, 48,000 favorable, I end up with a total $4,000 favorable variance. And again, Go back to your profits variance analysis. That agrees with our manufacturing variance for direct materials. One other caveat that I want to stress, and I mentioned as a note in my guide that I don't feel like the chapter necessarily addresses well, but it's knowledge you need to carry over from your intro to managerial accounting class, so it's been addressed there. This is a scenario where the amount of material purchased is exactly equal to the actual amount of material used, 176,000. Many of your problems, there will be a difference in the amount of material purchased versus used. So you'll see some on your quizzes, you'll see some on your exams. In that particular case, when we talk about the price variance for direct materials, the actual quantity is the actual quantity purchased. I want to stress that. Price variance, actual quantity be the actual quantity purchased. If the actual quantity used is different, for the quantity variance, the actual quantity wouldn't be the quantity purchased, it would be the quantity used. So I did want to go ahead and stress that. Now, I'm not going to go through all of the variable cost variance because I think once you find a pattern, it also is helpful for you to be able to work some on your own. Overall labor variance, you see a similar pattern in how it's set up. The quantity variance for direct labor is often called an efficiency variance, but again, you see a similar pattern in how it's set up. I at least want to get you started on how to find the information for direct labor. For example, the actual quantity for direct labor, we identified that it's 40,400 hours. The actual price, very similar. What's the actual labor rate per hour? They don't give it to us directly, but very similar to what we did for materials. We know that the total actual cost for direct labor was 1,010,000. We also know that we use 40,400 hours, so we can figure out that our labor rate per hour is $25 per hour. Another piece of information I need is standard price. Again, I want the standard price per hour, and that's going to be 24. Last piece of information I need for the efficiency variance is standard quantity. And again, very similar to what I did for direct material. Take the actual output that you sold of 94,000 liters and multiply it times the standard of what I thought I should have used for material, which is 0.5 or a half an hour, and that would be 47,000 hours. Again, gonna let you tackle the rest of the calculations, but feel free to come to me with any questions that you have.